Bismillahirrahmanirrahim. Assalamu alaikum. We will continue with our course Investment and Portfolio Management. Course code is MGT531 and today's lecture is lecture number 30. And reference book is the same as we have been doing in previous lectures. It was written by Christina in 2010. It was about the investment analysis and portfolio management. We will do the summary of the last lecture. First of all, in the last lecture we did psychological aspects in the investment decision making, cognitive dissonance. As far as psychological aspect is concerned, we did mental accounting and investment, sunk cost effects and mental budgeting. And contents of today's lecture are emotions and investment, risk and uncertainty, misattribution, bias and influence of mood. And we will continue with our topic, that is about the mental account and mental budgeting, that the most investors do not have efficient portfolios, and this is because that we have the conflicting and contradicting attribute of our mind, and contradicting and conflicting thinking of our mind with respect to any particular environment, with respect to any particular situation that we are trying to analyze. For example, sometimes we say that we are doing good and sometimes for our decision that we have made, we say that we have not made good decisions. And sometimes we think that we have a lot of knowledge and we can do our decisions in a very efficient way, and on the other hand we think that we do not have a lot of knowledge, we have a limited experience, limited knowledge and study, and therefore we cannot make an efficient decision. And investors are taking too much risk for the level of expected return they are getting. And as far as the decisions for the portfolio are concerned, we think that when we want to earn a high rate of return, the outcomes are the investments are the items which are likely to give us high rate of return. They are also associated with the higher level of risk. And this mental accounting leads to the other psychological biases like the disposition effect. Disposition effect is another important effect that result out of it, and we discussed in the previous lectures that this position indicate that we have two type of the arguments that come up in our mind. One are of the regret and feelings that we have, the painful feelings with reference to the negative outcome or loss associated with any decision. And on the other hand, we have the pleasure and we have happy feelings with reference to the our positive decisions, and we think that the decision we have made is good, and the decision we have made is likely to give benefit and the profit to the investor. And continuing, then we have the emotions and investment are topping. How important might be the emotions in the investor decision making? The investment decisions are complex and include risk and uncertainty. And we know that the decisions with reference to the portfolio holdings, they are complicated because they include the risk and uncertain situation. And when we have high returns associated with those outcomes and with those assets, we find that it is a sort of risky situation, and uncertainty may prevail in the environment or in the market. Or this uncertainty tells us that it is possible that we may have high profit, and it may happen that we do not have high profit. In the recent years, the psychologists as well as economists, they have examined all of emotions in decision making, that how the emotions they are likely to affect the decision making process. And psychologists they basically highlight the psychological aspect of the decision making, that what we think and what are the feelings that appear with us as a result of any decision. And economists basically they analyze the situation in the economic terms, that whether we are likely to have any positive economic benefit with our decisions, or we are likely to have any loss with reference to our particular decisions. And people who have stronger emotional reactions seem to let them impact their financial decisions. As some researchers conclude, the more complex and uncertain a situation is, the more emotions influence a decision has. What we can say that according to researchers and according to the empirical studies, we find that uncertain situation and complicated situations, they basically, and under those situations the emotions are likely to influence our decisions to a greater extent. And then continue with the discussion, we find that of course the background feelings or mood may also influence the individual investment portfolio decisions. The mood affect the prediction of the people about the future. If we have good prediction, we are not likely to have if we have good prediction of the time period and good prediction about the future investment and future outcome of the investment, so it is likely to it is likely to give us a good feeling. And if we think that the future outcome is not likely to have a positive impact on our decision, then it will definitely make us desperate and give us a worried feeling. And people often misattribute the mood they are in their investment decisions. Sometimes it happens that we off our mood without any reason with reference to our decisions, and this is known as misattribution bias. People who are in bad mood are more pessimistic about the future, and as compared to those who are in good mood. For example, if we are having bad mood and we are in desperate situation, we are pessimistic. We think that we are not likely to have higher outcome out of our investment in the portfolio, and we are not likely to have positive and higher monetary benefits with reference to our decision in our portfolio, and rather than who are having good mood. For example, those who have good mood, who make their decisions with pleasure, those who make their decision with confidence and with confidence in their ability, with happiness, they are likely to have positive return out of their decisions. They are likely to have positive outcome out of their decisions. Translating the behavior of investor, it means that the investors who are in good mood give higher ability of the good event or the positive changes happening. And those who and again we can say that if we translate the behavior of the investor into in terms of his investment and in terms of his type of investment, we find that the bad mood is likely to make his mind that the future changes in the outcome of the decision are not likely to be good for the investor. However, with the good mood, if we make our choices, we think that the future fluctuations, they are likely to have positive impact on the economic benefit of our decision outcomes, and we have the lower probability of bad changes happening. And so we can say that good mood will increase the likelihood of investing in the riskier asset. That when we have good mood, we will be able and we will have courage to invest in the investments, and to invest in the assets which are risky. And this is so because the risky assets are likely to be associated with the higher returns. And when we think that we are having risky asset, we think that it will give us higher returns. And with good mood, with happy mood, we will have courage, and we will be brave to undertake such investments. And however, we think that bad mood will decrease willingness to invest in risky assets. If we have bad mood, it makes us pessimistic. We think that our investment is likely to give us bad outcome, our investment is likely to give us bad results, and we will have the monetary losses. Therefore, we will less likely to take risk, and we will be less likely to take risky projects and risky investments. In other words, we can say the behavior make a person risk averse or the risk seeker. If we are good mood people and we take our investments with pleasure, we will be able, we will like to take the risk. We will be risk seeker. On the other hand, if we are pessimistic and we are having good mood while taking our investment, we will like to avoid the risk, and we will like to be risk averse. Even those investors who use quantitative methods such as fundamental analysis must use some assumptions estimating fair value of the stock. Given the influence of mood on uncertain decisions, that what is the influence of mood, what is the impact of mood on the uncertain situations. The expected growth rate taken for estimation of the value of the stock using DDM, which is known as dividend discounted model, we have done in the chapter number 4. So we can say that what is the positive impact of and possible impact of the mood on uncertain decisions. When we are doing decisions in uncertain or risky situations, the expected growth rate taken for estimations, they can be done. We can do that with reference to the dividend discounted models, and they may become biased and affect the overall result of estimated value of the stock. And an investor who is in a good mood may overestimate the growth rate. And one positive impact of the good mood or player mood is or being in the happiness situation is that we can overestimate the growth rate, or we can overestimate the gain of the capital with our investment, and this would cause the investor to believe the stock is worth more than the belief of the unbiased investor. And this type of investors are known as optimistic and optimist investors. And as a consequence for the optimistic investor in this case might be his decision to buy the stock with this which is underestimated based on his calculation, which in reality it is not. And we can say that if we are in a good mood, we can be known as optimistic, and we can be known as optimistic behavior. And and a good mood people, and investors, they will overestimate the growth rate. They think that what is the situation, ongoing situation with reference to the growth of the returns of any particular stock, the rate of returns will be greater than that, and will increase at a greater rate as compared to this situation. And therefore we can say that investors can believe that stock is more worthy as they are believing, and they think that this is a sort of unbiased assessment of the value of the stock. And because they are optimistic, such people and investors, they are optimistic investors, and they in his decision to buy the stock, which is underestimated when it is reality it is not. Similar, the investor who is in the bad mood may underestimate the growth rate. And on the other hand, we can say that the pessimistic investors are those who are in bad mood, those who are unhappy with the situation. They always underestimate the situation. They have less confidence to undertake their investment. They think that the rate of returns which they are observing with reference to any particular stock, it will go down as compared to what it is now now. And the stock value based on this calculation shows that stock is overestimated when it is not in reality. And he thinks that what is the value of the stock in the current situation. He thinks that this is overestimated, and in reality this is not the value of the stock. And because he is pessimistic, he underestimates the value of the stock and growth rate of the returns. So the investors make biased and mood-driven decisions might suffer losses. We can say that that such investors who are pessimistic, who keep themselves in the desperate situation, they make the biased decisions, and we can say they are investors making the biased decisions, and they are known as mood-driven decision maker also. And such mood-driven decision maker, they suffer from the losses because they are already, and in advance they think that that the rate of returns and expected rate of returns, they are not at that rate as they are appearing and they are indicating in the market. Rather their actual rate is at lower rate, and we can say they are basically indicating less value of the asset or the stock than the value in reality is. And investors who are in a big mood, a good mood, they can also suffer from too optimistic decisions. And what are these decisions? That optimism could affect decisions in two ways. And in other words, we can say those who are having good mood, those who undertake their decisions with the happy mood, with player, and they think that they are optimistic. They think that the future will bring good aspect and good result towards them, and the future outcome of their decisions will be good. And such optimism can affect such investors in two ways and in two sides. First is that investors tend to be less critical in making analysis for their decision investing in stocks, and second is that optimistic investors, they tend to ignore the negative information about their stocks. Even when they receive information about stocks, about negative results of the company they were invested in, and they still believe that the company is performing well. we can say that these are two important aspects which have which can affect the behavior of the investors as far as the investment is concerned, that they become less critical in making the analysis of the situation. As far as the investment is concerned, they do not criticize the returns and the environment prevailing in the market, and they also ignore the negative information about the stock, and sometimes it may happen that they overestimate the situation and they become overconfident about the situation, and they believe that the company is performing well, and the trends of the rate of returns and trends of the other factors which can be the buying prices of the stock or selling prices of the stock, they are behaving well and they are going in the right direction. And this is why the price of the stock is frequently set up by the optimistic behavior. Even if there are enough optimistic and pessimistic investors in the market, the optimists drive up the stock price with their buying, and because pessimists are passive. And what happens that the price of the stock is often set up by the optimistic investors, because they are optimistic. They think that market will go up, and they overestimate the current value of the assets. And although there are number of the investors, and these investors are both optimistic as well as pessimistic investors, but optimistic investors, they have the good behavior with the prices of the stock, and as far as the buying price is concerned, for example, they may offer higher buying prices as compared to the prices which are prevailing in the market. And what happens, we can say they would like to raise the prices in positive direction. And for firm with the high degree of the uncertainty, optimistic investors tend to set the stock prices until that uncertainty is resolved. And we can say that besides the optimistic investors, we have pessimistic investors, those who are averse to the risk to greater extent, who remains in the desperate situation as far as the rate of return of the stock is concerned, as far as the expected rate of return is concerned. Then what is the result and what is the outcome that they will offer the higher buying prices of the stock, and they will try to drive upward and drive the prices of the stock in the positive direction. And we can say that they will work a lot in order to resolve the pessimistic situation in the environment, in order to resolve the pessimistic and desperate environment as far as the rate of returns of the stock is concerned. And this is the struggle of this, and this may be the struggle of the optimistic investor, that they work a lot in order to improve the rate of returns and expected rate of returns of the stock in the market. And what happens as a consequence, the firms who are pessimistic, who are living in a great uncertainty and risky situation, they would behave in a positive manners. And the prospects of large well-established firms have less uncertainty, and we can say that because they have larger prospects of earning profit, and they are likely to have less risk, and they are likely to perceive that the situation is not too much uncertain. The stock prices are generally more reflective of actual prospects than of optimistic prospects of the investors. And this was the study by the Nofsinger done in 2008 about the behavior of the optimistic investors as far as the prices of the stock in the market are concerned, and how they would affect the pessimistic investors who are likely to avoid the risk and likely to avoid the uncertain situation. It is obvious that the weather has an influence on the mood of the people. Sunshine usually is associated with good mood and optimistic thinking, and without sun, people feel bad. And we can say that we have another important and interesting example, that weather can also influence the mood of the people, can affect the behavior of the people. If we are having pleasant weather, people are likely to behave in a good manner, they are likely to behave in pleasant manners, and they undertake a good and pleasant decisions, and definitely the outcome of such decisions will be good and will be pleasant. And then we think that on the other hand, for example, if we think that even if there is a sunshine and people The sunshine will make the people more happy and will make the people in a good mood, and they will have optimistic thinking about the environment, about the other peoples, about themselves. And if we do not have pleasant weather, if we do not have sun in the weather, we can say that people, they are likely to have bad feelings, they are not likely to have good feelings, and they will definitely they will be in desperate situation. They will feel bad as far as the people are concerned, and they will feel bad as far as the rate of returns and the environment of the trade is concerned in the trade sector or in the stock market. Some studies were performed to answer the questions how the weather might affect investors' behavior. So we have some empirical studies which basically indicate that how the weather affect the behavior of the investors, how the weather affect the mood of the investors. And these studies were done by the Schleifer and Shumway in 2003. These researchers found that the daily returns for sunny days are higher than the daily returns for non-sunny days, and when they conducted their studies while analyzing the impact of the weather on the mood of the individual, and they thought that the sunny days were likely to have good impact on the mood of the people, and people will take good decisions and optimistic decisions as compared to unsunny days. And the unsunny days, they were likely to impact the decision of the individual in a bad way. And researchers found that the daily returns for the sunny day are higher, and they are likely investors, they are likely to have higher returns and higher outcomes of their investment when there are sunny days, and when they are likely to have bad outcomes or losses out of their investments during the unsunny days for their decisions. And the results of this research allow to conclude that sunshine affect the investors, that they become more optimistic and are used to buy rather sell the stock. So we can say that there is sunshine, they are optimistic, and they would like to make purchases rather than to sell their existing stock. They will keep their existing stock with them, and they will try to and they will also try to purchase the more stock. Continuing with the discussion, emotions and investment, we find that this tendency prevails in the market. The stock prices are growing. The investors' behavior might be influenced by other factors which affect the emotions, and sport is another important example for this. Sport is investigated as one of the such factors. The research results of Edmonds, Gracia and Norley in 2007 showed that the stock market reaction to saucer game last day after for losing team stock market was negative. So we can say that there are important factors which are likely to affect the behavior of the investors in the stock market. For example, behavior may be affected by other factors which are likely to affect the emotions. Sport is one important game, and one important factor which is likely to affect the outcome of the returns of the investments of the individual in stock market. For example, according to a study conducted in 2007, when the stock market reaction was very bad. It experienced negative trends after the defeat in the saucer game in 2007. And the stock market reaction was stronger in countries which have positive historical result in the saucer. And this is another interesting result, that there was seen a downfall and negative trends in the stock market in 2007 after the loss or defeat of the saucer game. And this loss or this negative returns and negative trends in the stock market were observed very badly in the countries where the saucer had good results in the history. And the saucer game has been showing a always winning aptitude in the history. However, the general level of the optimism and pessimistic social mood changes over time. As Nofsinger in 2005 conducted that this in his investigation, that the general optimism and pessimism level or the social mood, they changes over time. For example, we can say sometimes we are optimist and sometimes we are not optimist, we are pessimist, and sometimes on the other hand we are in desperate situation, we are in emotional shock, and some other time we are in a happy mood, we are having a social changes in our mood, and we are optimist. And this was the study conducted by the Singer in 2005, and the investors tend to be most optimistic when the market reaches the top, and they are most pessimistic when the market is at the bottom level. And how the mood of the individual investors changes or fluctuates with reference to the fluctuations in the stock market. We can say that individual, they tend to be optimistic, they tend to be happy, they feel player, they have good emotions when they feel the stock market is moving in right way and is moving in upward direction, is at maximum level. However, they do not show positive mood, they show a bad mood, they are in desperate situation, they are pessimistic, they feel unhappy and sad and worried when they find that the trends in the stock market, they are showing a negative direction. The prices and the returns in the stock market, they are showing negative slope, and they ultimately they reach at minimum level. So we can say that, in other words, we can say that as far as the mood of the investors is concerned, their optimism and their pessimism is concerned with the outcomes of the stock market, and they are concerned with the monetary terms. If the investors, they are likely to have monetary gains, their mood will be good, they will be optimistic, and they will feel player. However, when they think that their mood is likely to they are likely to lose in monetary terms, their mood will be unhappy, and they will feel unplayer and distressed and discomfortable with the situation. So therefore we can say there is a strong association between the mood of the individual investors and the situation prevailing in the stock market. This fluctuating social mood is defined as market sentiment, and such type of fluctuation in the social mood of the individual investors are known as market sentiments. And the sentiments of the individual, they are associated with the sentiments and with the changes and fluctuations prevailing in the stock market. Knowing the phenomena of market sentiment might allow to predict the returns in the market when investors become too optimistic on the top of the market or too pessimist when market reaches at its bottom. So we can say that phenomena of the market sentiment is associated with the mood of the investors, and it is helpful to predict the mood of the investors. For example, when we find the good trends are prevailing and market is showing good results, we can predict that the mood of the investors will be good and they will show optimism. And however, when we find the stock market losing its returns, so we can predict the mood of the investor that they will show a pessimistic result, or they will show a desperate situation. A market bubble could be explained by this situation. When high prices seem to be generated more by investors and traders in the market optimism than by economic fundamentals, extreme prices that seem to be at odds with rational explanations have occurred repeatedly throughout the history. And then we will have the summary of the chapter. We will summarize the chapter. We start from the overconfidence, and first point of the summary is that overconfidence causes people to overestimate their knowledge, risk, and their ability to control events. This perception occurs in investing as well, and that is, we can associate this overconfidence and overestimation and of the knowledge and risk and of the ability and of the experience of the individual with reference to the investment in the stock market and the financial market. This perception occurs in investing as well. Even without information, people believe the stock they own will perform better than stock they do not own. That is, we can say this is the impact of the overconfidence, that they think that their decision is good, what they have decided was good because they were having a proper knowledge, they were having a lot of experience, a lot of study and information, and what they are doing is good as compared to what the others are doing. Typically, investors expect to earn an above average return. And second is, overconfidence can lead investors to poor trading decisions, which often manifest themselves as excessive trading, risk taking, and ultimately portfolio losses. If many investors suffer from overconfidence at the same time, then signs might be found within the stock market. And third is that overconfidence affects investors' risk-taking behavior. Rational investors try to maximize returns, then minimizing the amount of risks taken. The overconfidence affects the risk-taking behavior as well. That those who are rational investors, those who are wise and profit optimizer, they try to maximize their returns and they try to minimize their cost, which can be the risk also. However, overconfidence investors misinterpret the level of the risk they take. Sometimes they think that they underestimate the level of the risk associated with their investment. Because of their overconfidence, they think that the risk that the outcome they are going to choose is less risky. And we can say basically they misinterpret the level of the risk, and sometimes it may happen as a result of this misinterpretation they lead to the loss of their investment and loss of their earnings. Avoiding regret and seeking pride affects person behavior, and this is called the disposition effect. And fearing regret and seeking pride causes the investor to be predisposed to selling winners, potential stocks with growing market prices too early, and riding losers, stocks with the negative tendencies in market prices too long, and selling winners too soon, suggesting that those stocks will continue to perform well after they are sold, and holding losers too long suggests that those stocks will continue to perform poorly. And the house money effect predict that after experiencing a gain or profit, people are willing to take more risk, and the investors are more likely to purchase high risk stocks after locking in gain by selling stocks at a profit. And then we have next point of the summary, the snake bite effect. Snake bite effect predicts that after experiencing a financial loss, people avoid to take risk in their investment decisions. The endowment effect is when people demand much more to sell things than they would be able to pay to buy it. Closely related to endowment effect is the status quo bias behavior of the people when they try to keep what they have been given instead of exchanging. The status quo bias increases as number of the investment option increases. That means the more complicated the investment decisions that needed becomes, the more likely the person is to change to do nothing. And the next point is that about the memory. Memory can be understood as a perception of the physical and emotional experience, and memory has a feature of adaptivity and can determine whether a situation experienced in the past should be desired or avoided in the future. Usually the people feel better about experience with the positive peak and end, and the memory of the large loss at the end of the period is associated with a higher degree of emotional pain. And point number 9 is about the cognitive dissonance. And cognitive dissonance is based on evidence that the people are struggling with two opposite ideas in their brains. One is that I am nice, and second one is that I am not nice. To avoid psychological pain, people used to ignore or reject any information that contradicts with the positive self-image. The avoidance of the cognitive dissonance can affect the investor's decision-making process. The investors seek to reduce psychological pain by adjusting their beliefs about the success of past investment decisions. The mental budgeting matches the emotional pain to the emotional joy. The pain of the financial losses could be considered as similar to the cost associated with the purchase of the goods services. Similarly, the benefits of the financial gain is likely to joy a benefit of consuming goods and services. And the next summary point is that people behavior which more consider historic cost when making decisions about the future is called the sunk cost effect. And continuing with the summary point, we find that sunk cost effect might be defined as an explanation of commitment to continue an endeavor once an investment in money or time has been made. and the size of the sunk cost is very important to decision making. The larger amount of money was invested, the stronger the tendency for keeping the going. That we can say that if the individual investor has made a lot of money as investment, he will keep his investment for a long time period. And next point is that people have different mental accounts for each investment goal, and the investor is willing to take different level of the risk for each goal. Investments are selected for each mental account by finding assets that match the expected risk and return of the mental account. Each mental account has an amount of the money designated for that particular goal. As a result, the individual investor portfolio diversification comes from the investment goals diversification rather than from a purposeful asset diversification according to the portfolio theory. And 13th important point is about the emotional fluctuations in the mood of the individual decision maker and individual investors. And we can say that we have the two types of investors as far as the emotions are concerned. They are optimistic, they are pessimistic on the other hand. And mood affect the predictions of the people about the future. And misattribution bias predicts that the people often misattribute the mood they are in and into their decision. People who are in bad mood are more pessimistic about the future than people who are in good mood. For example, those who are in bad mood are pessimistic. They think that the future outcomes of their investment will not be so good, and they will not be likely to have high returns in the future as a result of their investments, as compared to those who are having good mood. Those who are having good mood, they are optimistic, and they think that the investment will give them higher benefit in the future time period, and then they will get high returns out of their future benefits and out of their investment in the current time period in the future time period. And the translation to the behavior of the investor, it means that the investors who are in good mood, they give higher probability of good events, positive changes happening, and a low probability of bad changes happening. So we can say, if we translate the behavior of the investors with respect to their the investment, we can say that those who are optimistic, those who are in good mood, those who are indicating a player with reference to their investment, they think that the probability of happening of the higher and positive outcomes is higher as compared to the probability of having the low returns in the future time period. So they think that the future events will likely to give high returns to the individual investment at the present time period, and as compared to that they say that the future outcomes will be low profit giving to them. And 14th point is that different level of the optimism and pessimism are social mood changes over time. And investors tend to be most optimistic when the market reaches top, and they are most pessimistic when the market is at the bottom. And if we associate the behavior of the psychological emotions of the investors with the fluctuations prevailing in stock market, we can find that when market shows positive trend in its indicators, and when it is at peak level, the investors, they feel good, and they feel pleasure and happiness, they have good mood, they become optimistic. However, when the market is at show downturn and is at bottom and recession, so we can find that it is basically indicating a downfall in the indicators and trends, and have negative impact on the mood of the investor, and the investor will be in desperate situation, will become pessimistic, and will show displeasure. This fluctuation in the social mood is defined as market sentiments. And the 15th point is that a market bubble could be explained by the situation when high prices seem to be generated more by investor trade in the market optimism than by economic fundamentals. This was the end of the summary points. Now we have the key terms that we have been doing in the chapter, emotions and the investment. And the first is cognitive dissonance, disposition effect, emotions, endowment effect, house money effect, market bubble, market sentiment, memory, mental accounting, misattribution bias, overconfidence, snake bite effect, and sunk cost effect. And after the key terms, we have the question and problems associated with this chapter. The first important question is that why the portfolio of overconfident investors have a high risk. Give the reason. That you will have to provide the reason and justify that why the portfolio of overconfident investors and decision makers is highly risky. Second important question is that give the characteristics of overconfident investor. Third is that why the investors tend to sell losing stock together on the same trading session and separate the sale of the winning stock over the several trading sessions. And fourth is that explain how mental accounting is related with the disposition effect. Fifth is how do you understand the disposition effect, that what the disposition effect is. Sixth is that give the examples how snake bite effect influence the investor behavior as far as the decision making and the investment of the stocks is concerned. Question number 7. The behavior of the people when they demand much more to sell things then they would be willing to pay to buy. It is understood as snake bite effect, house money effect, endowment effect, disposition effect, or sunk cost effect. Question number 8. Explain how the avoidance of the cognitive dissonance can affect the investor's decision making process. Question number 9 is give the examples how the emotional influence investors decision maker, that is how the emotions they are important to affect the decision making of the investors. Question number 10 is how could you define the market sentiment. Then we will continue with the next chapter, that is about using options as investment. Many contents of the chapter are essentials of options. What are the essentials of options? Option prices and using options, profit or loss on options, portfolio protection with options, hedging, summary, key terms, and questions and problems. We will start with the essentials of the options. And option is a type of contract between two persons where one person grants the other person the right to buy or to sell a specific asset as a specific price within a specific time period. The most often options are used in the trade of securities. Option buyers is the person who has perceived the right and thus has a decision to make. Option buyer must pay for this right. And option writer is the person who has told the right and must respond to the buyer's decision. We have types of option contracts. We have first type of option are known as call option. It gives the buyer the right to buy the call away a specific number of shares of a specific company from the option writer at a specific purchase price at any time up to including a specific date. And second type of options are known as put options. What are put options? It gives the buyer the right to sell, to put away a specific number of shares of a specific company to the option writer at a specific selling price and at any time up to including a specific date. And option contract specifies 4 main items. What are these main items which are relevant to the option contract? First important is that the company whose share can be bought or sold. That option contract specifies the first main important is the company whose shares they are bought or sold. Second is the number of the shares that can be bought or sold, that how much are the shares that can be traded. And third is the purchases or selling price for those shares known as exercise price or stock price. First is and fourth is that date when the right to buy or sell expires, known as expiration date. We can say that what are the 4 main items concerned with the option contract. First is the from which company the trade in terms of purchase and sale of the shares is made, and second is the number of shares which are traded or bought or sold. Third is the number of the purchasing and selling price, and which is known as exercise price or strike price. Fourth is the expiration date, that the date at which the right to buy or sell expires. And then we have the types of call and put options. We have the European options and American options. These two are the important or basic types of options. And the first are the European options. They can be exercised only on their expiration dates, and American options can be exercised any time during their during their life defined by the option contracts. The major advantage of investing in options. What are the major advantages of investment in the option? The possibility of hedging. Using options, the investors can block in the box his or her return already earned on the investment. And the option also limits exposure to risk, because an investor can lose only a set amount of money the purchase of the option or the purchase price of the option. Put and call options can be used profitably when the price of the underlying security goes up or down. The major disadvantage of the investment in the options: the holder enjoys never interest or dividend income or nor other ownership benefits. So what are the major disadvantages of investment in the options? The holder enjoys never interest nor dividend income and nor any other ownership benefit. This is the one major disadvantage of investment in the options. Second is, the reason is because put and call options have limited lives. An investor have a limited time frame in which to capture desired price, behavior, or because this is so because these options, they have limited life. And this investment vehicle is a bit complicated, and many of these trade strategies are complex for the non-professional behavior. So we can say that as far as these investment vehicles or options are concerned, these are complicated, and the investment and trade in them is complicated for the non-professional investors, and non-professional investors will find it difficult to invest in these particular types of options. And further in this chapter, we focus only on some fundamental issues of investment in stock options, including some most popular strategies. Portfolio protections with options. Hedging. Portfolio protection with options is hedging. Hedging basically with options is specifically attractive because they can give protection against loss, or the stock protects the option against loss. And we can say that hedging with option is attractive because they can give protection against the losses from the investment. A hedger is an individual who is unwilling to risk a serious loss in his or her investment position and take the action in order to avoid or lessen the loss. So who is hedger? What is the feature of the hedging? And a hedger is the one who is unwilling to take the risk, and we can say that he is averse to risk, and he in his investment is likely to avoid the risk and to minimize the risk. Using options to reduce the risk. Suppose the investor currently holds the shares of the company X in his portfolio, and price of the share is 8 to 5 euro. 85 euro, and look at the future. The investor is not sure in what direction the price of this share will change, and if the price will grow and may become 9 euro from the 8. By holding these shares, the investor could receive the profit, but if the price will fall maybe to 8 euro, the investor could suffer the loss. The one way to avoid this downside risk is to sell the shares. The problem is that the investor may regret this action if the fall of the price of the share does not occur and investor has foregone the opportunity to earn a profit. So what happens? We can say that the hedger, as far as the portfolio protection with options is concerned, hedging is important one. And what is hedging? Hedging is when the investor want to avoid the risk, want to minimize the risk, and invest in the options which are likely to give less risk, and we can say he is risk averse, and definitely he would like to avoid the investment from which he would have to have the regret. And we can say that he will definitely, an investor has foregone the opportunity to earn a profit if the prices of the share fall, and he will feel better if the prices of the share rises after a purchase of that share, after a purchase of that particular option. An alternative approach is to retain the shares and buy a put option. This option will rise in value as the share price falls. And we can say when the price is likely to fall, the investor should follow the put option, and he should retain the shares with himself. If the share price increases, the investor gain from his or her underlying shareholdings. The hedging reduces the dispersion of the possible outcome to the investor. So we can say that if the share prices they increase, an investor is likely to have gain out of his shareholding and out of his investment with respect to the shareholding, then hedging reduces the dispersion of possible outcomes to the investor. We can say the fluctuations with respect to the prices of the share minimizes and reduce. And there is the floor below which losses cannot be increased, while on the upside the benefit from any increasing in the price of the share is reduced due to option premium paid. And but if the price of the share stands still and it is €85, the investor may feel that the option premium he or she paid to ensure investment and adverse movement at €0.85 or 10% of the share price was excessive. If the investor will keep buying this type of the insurance, though it can reduce investors' portfolio returns during the longer time, for example a year, substantially, using option to reduce losses. Suppose that the investor wants to buy the attractive share of the company B in his portfolio and the current market price of the share is €9. The investor is fairly sure that this share will rise in future and in terms of the prices, but is not confident that as to discount possibility of a fall in the price, and maybe the price of the share fall to €8.5. And how could the investor behave? He or she can either exercise a direct purchase of these shares in the market at current price, or to purchase a call option with underlying stock of the company B. And if the price of the share does fall significantly, the size of the loss is greater with the share price because the option loss is limited to the option premium paid. And hedging portfolio of shares using index options. And that is what is the hedging portfolio of shares with the use of index options. Large investors usually manage varied portfolio of the shares, so rather than hedging individual shareholders holdings with options, they may hedge their portfolios through the options on the entire index of the shares. Index option is based on stock index instead of an underlying stock. And when index option is exercised, settlement is made by cash payment, not delivery of shares. The most often index options are settled on the basis of such index as Stanford and Poor's 500 and USA etc. Suppose the investors manage a well diversified portfolio of the shares and currently is concerned with the market may fall over the next 3 months. The one of the possible investment strategy for the investor to buy is to put options on the stock index. And if the market falls, losses on the portfolio will be offset by the gains on the value of the index put options. And if the portfolio is unhedged, the investor suffers from the market fall substantially. But it is important to remember about the expenses of the insurance of the portfolio. When the options premium are high during period of market volatility caused by economic crisis, hedging of the portfolio of stocks with index options over longer period could be expensive. At the end, I will give the summary of the lecture that we have done here, and we will rediscuss the concepts that we did in this lecture. And we will first of all look at the contents of today's lecture. What were the contents of today's lecture? And these were about the emotions and investment, risk and uncertain situation, misattribution bias, influence of the mood. And as far as the mental budgeting is concerned, we said that investors do not make the efficient portfolios, and they are taking too much risk for the level of expected returns. They are getting the thing because the returns are expected to be higher, and they will invest in the assets which are likely to be more risky. And this mental accounting is known as psychological biases or the disposition effect. And emotion, and as far as emotion and investments are concerned, how emotion important might be the emotions in the investment decision making. And we can say that the investment decisions are complicated and when they include the uncertain and the risky situation, and the psychologists as well as economists, they are concerned about the role of the emotions in the decision making. People who have stronger emotions, their reactions seem to let them impact their financial decisions. And of course, the background feelings or mood may also influence the investment decisions, that whether we are having good mood or bad mood. Often the mood affects the predictions of the people about the future, and people misattribute the mood they are in into their investment decision. This is known as misattribution bias, and people who are in bad mood are more optimistic about the future than the people who are in good mood. And we can say good mood will increase the likelihood of investing in riskier assets, and bad mood will decrease willingness to invest in the risky assets. And given the influence of mood on the uncertain situation, we can say that the expected growth rate, they can be estimated with the help of discounted dividend model, as we done in the chapter number 4. And we can estimate the an investor who is in a good mood may overestimate the growth rate, and we can say that this would cause the investor to believe that the stock worth more than the belief of the unbiased investor, and his decision to buy the stock is underestimated based on his calculation than what is in reality. And however, as far as the bad mood is concerned, such people, they underestimate the growth rate of the variable, and investors making biased and mood driven decisions, they might suffer losses, and they think that this situation is basically overestimated. However, returns are not at that high as they are indicated by the market. And we can say that optimism can affect the investors in two ways. First is that optimists, they do not criticize the directions and trends in the market, and second is that they ignore the negative information associated with the stock. And we can say that we have the Nofsinger 2008. It was the study conducted by the Nofsinger, that the stocks prices are generally more reflective of actual prospects than of the optimistic prospects of the investors. And then we can say that we have another type of the impact, or another factor which can impact the mood is sunshine. That we can say sunshine is likely to, or pleasant weather is likely to is associated with good mood and optimistic thinking than the people without pleasant weather. And those when the weather is not pleasant and there is do not have sun, people feel bad. And then we can say we have another example, that the other factors in the political sector prevailing, they can affect the outcomes of the stock market. For example, the sport is an important factor which is likely to affect the trends of the stock market. For example, if we are having we win any game, the trends in the stock market, they will show positive direction. And if we defeat in any game, so we find that the indicators of the stock market, they will show negative trends, and this happens particularly in the countries with reference to the game which they have been winning for so many years. And we can say also that investors, they tend to be most optimistic when the market reaches top, and they tend to be pessimistic when the market is at bottom level. And these type of fluctuations in social mood of the investors are known as market sentiments. And we can say that when investors become too optimistic on the top of the market, or too pessimistic when the market reaches the bottom. And we can say that bubble price could also explained by the situation when high prices seem to be generated by the investors, or when there are high prices prevailing in the trade market. And then economic fundamentals, they indicate the optimistic behavior of the individual. Extreme prices that seem to be odd with rational expectations have occurred repeatedly throughout the history. Then we provided the summary of the chapter, and after providing the summary, key terms and question and problems, we started the next chapter, which is about the using options as instruments. And we the main contents are the essentials of the options, option pricing, using options, profit or loss options, hedging, and so on. And what is the speciality and what is the definition of the options? Option is a type of the contract between two individuals where the one individual grants the other individual the right to buy or to sell a specific asset at a specific price within a specific time period. And the most oftenly the options are used in the trade of the securities, and the option buyer is person who has received the right and thus has a decision to make, and option buyer must pay for this right. Option writer is the person who has sold the right and must respond to the buyer decision. Then we have the call options and the put options. Call options are the basically gives the buyer the right to buy a specific number of shares of specific company from these option writers as a specific purchase price and at a given time. And the put options give the buyer the right to sell or to put away a specific number of shares of a specific company to the option writer at a specific selling price and the time. And then I can say we have 4 important points of the option contract. First is with which company the trade in terms of the share is being done, and what is the number of shares which will be purchased and sale, and what will be the price of the purchase and sale of the shares, and what time and what will be the expiry date for the purchase and sale of the of the purchase and sale of the option. Then we did that we have 2 options, particularly European and American. European option, they can be exercised on they can be exercised or traded on their expiry date, and the American option, they can be exercised any times. And advantage of the investing is the possibility of hedging. That possibility of hedging is there, and main advantage of the hedging is that they limit the exposure to risk. And then we have the disadvantage of the hedging, and that is holders enjoy never interest nor dividend nor any other ownership benefit. And we can say that if we can protect our options with the help of the hedgings. And hedger is one who is unwilling to take the risk and who is averse to risk, or in other words we can say that he will try to minimize his level of risk. And this was the end of the today's lecture, and I hope you will be able to understand your lecture in the light of the discussion we made here, in the light of the slides presented here, and in the light of the reading material. And try to understand and try to study your lecture, and take care of yourself, take care of your studies as well. And Allah Hafiz, up to next lecture.